Long-term buy and hold is for savages. So if you're not willing to be a savage, get the out of here, turn the show off, go listen to something else. Flipping is flashy, wholesaling is fast, but long-term buy and hold, that's discipline.
Well, we talk about buy and hold on this show all the time. And I'm not gonna lie, we're human as well. Like Gabe, you and I were just talking about before the episode that we're holding some assets in a particular market that's been challenging. Multifamily, cost of maintaining have gone up, cost of labor, insurance, hell, 49% tax hike on one of my properties. We're protesting it. It's easy to just be like, I'm done. I hate this asset class. I hate this location. I'm done. And I do believe though that, a lot of people are exiting because they are tired of the rate hikes. They are tired of the headaches that have happened. I mean, real estate's been tough the last few years, but the people that can hold on and ride it out, they almost always win.
That's all I mean by being a savage. For one, I like the word savage, so I'm just going to say it as many times as possible in this episode. And I also don't know if that intro or, when I get excited about something, I tend to cuss a lot. So, maybe that will all get bleeped out because I'm just going off about being a fucking sap.
But also when you talk about, I'll just say to you guys, when you talk about Oklahoma properties or properties that aren't, the average property for you guys, right? It's like, okay, so there's some challenges there. They suck for a little while. It's also because you're comparing them to all the other properties in your portfolio that are so fucking awesome. So there's also if you, for example, in Oklahoma, you stabilize, you hold those properties. If they don't go up a dime in value, but you pay them off in 20, 25 years, that's a lot of value for you guys. Real estate tends to correct itself. Yes, I get it. There's challenges, but overall, there's a tailwind even with tough real estate. So yes, maybe those properties look bad compared to other ones you've done in your portfolio because those look really awesome. But real estate, because you have tenants paying down debt and you have tenants paying utilities and paying for maintenance over, real estate has tailwinds no matter what market that is, as long as you can hold for long enough. I tend to believe that.
Real estate wins long-term almost always. You just have to have the balls to hold on. You gotta have enough emotional intelligence to just fucking hold. If you allow yourself to make emotional decisions, you're gonna make bad decisions. You're gonna sell properties you don't need to sell. Now I understand there's an argument of getting that emotional annoyance off your plate. I'm not saying don't ever sell. And there's a time to do it. But what I am saying is real estate wins over time, even the challenging properties. I watch young investors or new investors. I've watched people buy one rental property. They have one bad tenant. They have one bad thing happen. And they're like, I'm done. I'm out. I'm not buying real estate again. I'm never doing it again. All real estate sucks. It ruined my day. It ruined my life. It ruined my, my wealth. And it's just not the case. If you have the willingness to just hold on and see things through and actually buy more real estate, shit's going to happen, man. We've talked about this past episodes. Choose your hard. I'd rather, have hard things in real estate than not own real estate and have other hard things in my life because I don't own real estate.
Well, and everything's cyclical too. I mean, there's a reason if you want to, people asking, well, why yes, you pay down debt, you can hold for the long term. But even in say multifamily, we've talked about multifamily. I think our analogy of buying that one single family house and having a bad tenant and saying, I'm out, I hate real estate, I'm going to go back to my W-2 job or whatever the case is. That's almost identical to us owning these classy multifamily apartments that we kind of got, and we were passive investors and now we're at the, we're operating these assets. I'm just as emotional. I own mobile home parks. I love them. I hate these Class C multifamily assets. I literally hate them with all my heart and all my emotion, but it's the same as that single family house. You hold on to it and all of a sudden fundamentals change, right? In that example, Oklahoma City, there's not a lot of building happening, right? So absorption's starting to happen. Rent are coming up. And that's the other thing, Mitch, that you omitted in what you said earlier is that the cost of living is going up and a major cost of living is rent. The government prints money, inflation happens, it keeps going up, and that directly ties to rent. And when your rents go up, and if you can outpace the expenses, your values are going to go up. And then you create more equity because you're also paying down debt. And when you have equity and assets, you have optionality. You can do things with that equity, whether it's refinance out, sell it. Yeah.
The other thing too, we don't talk about a ton is, if you have debt at 6% and inflation's at 3%, the government's paying 3% of that debt, not on a monthly not on a monthly basis, but they are depreciating the underlying value that the debt represents at the inflation rate. So $1 million of debt, 3% inflation year, that $1 million represents 30,000 less in value that particular year. Over 10 years, that would be $300,000 in less value that the underlying debt represents. In other words, the underlying debt is truly, from a value perspective, shrinking every single year we have inflation, even if you have a little bit of an interest rate attached to that. So over time, there's just all these pieces and parts that are like a tailwind. But in the short term, I think that we experience these challenges and it gets us discouraged. We have a hotel, Travis and I, that we've had to do some renovations on, $100,000 worth. In the short term, you're like, gosh, this sucks. Like, we don't love that. No one loves that. But in the long term, every single tailwind is behind us, and I think it'll be great property, and we'll do fine. And in fact, the value's doing pretty well right now. We're picking up. So I just think like the long term absolutely wins, but if you take a short term perspective, then you're likely to lose in this game.
But real estate is long term, and that was my point. I mean, I opened this show with saying long term buy and hold is for savages, flipping is flashy, wholesaling is fast. If you're a true real estate investor, you're looking at the long term. We say it all the time. We're long term buy and hold. We believe in real estate long term. Flipping properties is not investing. Wholesaling properties is not investing. You know, buy and hold, like, there's some cultures like, you know, I know politically, like China looks out like 100 years from now, 500 years from now. How are these decisions we're making today going to impact future generations 100 years from today, 200 years, 500 years? I think real estate investing is similar. You meet a lot of young investors or wannabe investors that are like, how do I make money today? And I'm not saying there's anything wrong with that. Go ahead and flip a property if you think you can make money. Wholesale a property for some fast cash. But real wealth building is long term. And it's having the discipline and having the understanding that the decisions you make today could impact your life in a great way financially 10 years from now, 15 years from now, 20 years from now. And you can't time the market. I mean, it's the old adage of like time in the market versus time in the market. If you if you have enough real estate and enough time in the market, you will succeed with your investing. It's those that are looking for fast cash, quick, fast, easy money that usually get their ass kicked in real estate, or they allow one bad thing, one problem, one issue to completely wreck them mentally and emotionally. It's less about the property itself, and it's more about having I think the strength and the mental fortitude to go, hey, shit's gonna happen in real estate, but I'm looking at this. What will this property do for me 5 years from now, 10 years from now, 50 years from now that it won't do for me if I didn't own it?
Well, it's also like getting outside of this sort of popcorn brain culture where it's flashy and I need quick wins and I'm on social media and someone exited and make a bunch of money and we're all entrepreneurs. I mean, I know I'm guilty of this. I sometimes have shiny object syndrome. It's sort of quieting that part of your brain and just acquiring for the long term and holding for the long term. Also, you can have big capital events and long term hold real estate. You can then grow your equity and pay down your debt through forced appreciation, which we talk about all the time, and do a refinance, cash out, tax free, tap the equity, redeploy it into another asset. So you can be a long term buy and hold investor, but also have large capital events that are absolutely meaningful.
Life changing meaningful. I mean, I've had the experience on properties that I bought for long term cash flow. But again, it's not time in the market. It's time in the market, and then you look smart because when the opportunity is in front of you, you can pull the trigger. There's a time like when interest rates dropped and cap rates were being compressed. It was a great time to refinance, right? I mean, I did this on my first several mobile home parks, right, where I was financing the majorities with hard money, some with seller financing, but then it became a perfect time for me to refinance these. It looked like I timed it perfect. All it was I was buying real estate all the way through. And then there's an opportunity where prices are up, interest rates are low, and it's a great time because I have time in the market to take advantage of where the market is. And if you own enough real estate for a long enough time, you will always have these cycles where you can take advantage of the market and have these huge liquidity events like you're talking about, Travis. But it's the cash flow that often allows you to hold it to where you're in a position to either sell, refi, restructure something to actually to benefit from that capital event.
Well, take that example. Let's give us one of those parks, Gabe. What'd you buy it for? What did it appraise at? How much cash did you pull out? And then the last question is, what is it worth now? Because you held it. You didn't sell it. You didn't pay capital gains. You actually held the asset, and you had a big liquidity event. So, like, run us through just quickly and what maybe one of those.
Real life example. I bought my first mobile home park in 2019. I paid $1.3 million. I was no real money out of pocket. To go back even farther, I sold a single family home, did a 1031. So I used that money. So it's all house money to put down on this mobile home park. So no real money out of pocket. Bought this mobile home park for 1.3 million. 2 year, I used hard money at eight. I borrowed hard money at 8.25. 2 years later, that property that I bought for 1.3 million appraised at 2.775 million. I believe I pulled out somewhere between $700,000 and $800,000 of tax-free money. I refinanced that property, I think at 4.125%. And so my cash flow, it cash flowed at the 8.25. My cash flow didn't change much, but I had the liquidity event. I now had $800,000 to go redeploy into another deal. I actually took that $800,000 and reinvested that money. So that was tax-free money because it was debt. I actually put that money down on a triple net commercial portfolio that puts six figures in my pocket every year. And so that's a real life example.
All starting from a single family house that you bought, probably no money down, owner finance.
If you like what you're hearing on this podcast and want to come and hang out with us, as well as other members who are scaling in cash flow real estate, you've got to check out our elite mastermind. Inside, we've got investors who own hundreds of millions of dollars in real estate and are doing amazing things. We'd love for you to come join us. Click the link below.
And I paid 1.3 for that mobile home park. It appraised at 2.775. Some of that was cap rate compression. Some of that was increasing the NOI by decreasing expenses, increasing revenue. I started billing back utilities that cost me nothing, small rent increases that cost me nothing. And then I had the market on my side in terms of prices and interest rates. So I took advantage of that market and I chose to refi, pull the cash out to redeploy, not to go buy a bunch of stupid shit, but to go redeploy that into other real estate that's going to put even more money in.
But it'd have been fine had you not refinanced and just held it at the 8.25% hard money loan. So my last question to that is, it appraised at, what'd you say? It appraised at 2.77. So what is it worth now? What is it worth now? Would you estimate it?
I'm not sure. I mean, I think probably slightly under 3. I think that there was a lot of value add in terms of increasing the NOI during those first couple of years. And then it's kind of been steady. So if I had to guess, yeah, maybe around 3 million, maybe a little bit under. But a lot of that initial value was by increasing the NOI, decreasing expenses, increasing revenue. That was a part of it. And then, I bought well. I bought a park that was undervalued. The first several parks I bought for way below what I think that they could have sold for a year later.
Did you know that you were buying that low at the time? Did you know that, or were you just looking at the cash flow basis, basically?
I was looking at the cash flow. I knew there was room to increase the cash flow. I refinanced my first 4 parks and they all had very similar stories. I refinanced in I want to say late 21 or early 22, where interest rates were low and all of these mobile home parks appraised out really high because the market, it was getting frothy, but also I was able to increase NOI on these parks. And as you guys know, as you increase NOI, you're increasing the value of the property significantly. So I wasn't looking at the equity potential. I was looking at long-term equity growth, but I was really focused on the cash flow. But then I had the decision, like, do I pull max cash out? And it's kind of the question of like, hey, if you can tap your equity today, if you can get 10 years of cash flow today, maybe you should sell. Or in this situation, maybe you should refinance and pull cash out. Because today I own those properties, I tap the equity, they still cash flow, and I had the liquidity to redeploy, and I own those properties. And that's the true value of real estate. And that is the game of long-term buy and hold. That's not flipping. It's not wholesaling. That's buying a property on fundamentals that work today. And then when the market puts you in a position where you can make a move to even better your scenario, then you do it. Then you just have that lever to pull. You pull it, you still own the real estate, and go buy more real estate and ride off into the sunset. I don't know.
Well, I love it because, Travis and I are working on a property right now that, we're going to harvest a lot of the equity, just like you're talking about. It's got a lot of equity in it. We don't want to sell it. We're going to refinance it, but it's a tax-free event. We're able to take that, redeploy it into something that's even stronger that we can go grow again. I just don't know, if you put a flipper up against a long-term hold guy or gal, I think what you see is you see early that the flipper is winning. At least it looks like that, and it looks
The
shiny and
rabbit
it
gets
looks
the
good.
turtle in the hair, right?
Yeah, and it might be a couple years. Like it might be a couple years, maybe, where the flipper looks smart, and they're like, "Oh man, I'm crushing you. I don't know what you're doing." But you get into that like year 3, year 4, year 5, somewhere in there, and all of a sudden it's like, "Oh my God, what's happening?" The long-term holder is pulling tax-free money. The long-term holder has a lot of cash flow. The long-term holders has a lot of debt pay down.
And owns a lot of
Is
assets.
owns a lot of assets, is not paying the government. So like I think that like yeah, the short-term brain wants the fast money, but, like, if you can think beyond that 2, 3 year mark, the long-term holder's always gonna beat the flipper, and then what happens is the convergence gets really, really massive when you hit, like, 10 years. It's a night and day. It's compounding, and so the flipper's still doing the same thing, still spending time, swinging the hammer and paying the government, and the long-term holder is living an entirely different life. It really, really starts to diverge in a big way.
There's so many flippers we talk to that have flippers remorse, right? That are saying, "Man, I wish I'd have just held more of those things." Like if I would have just held half of them or a quarter of them, I'd be in such a better position right now. I think every
It's a thousand
flipper I've
percent. It's 1,000%. Like, Mitch, you say 3, 4 years. I think sometimes it compounds that fast. Sometimes it's 10 years, 15 years, right? Where you really start to see this. But I mean, I saw the same thing. I was just stacking properties, stacking properties. I knew people flipping homes and making money, but they weren't building wealth. At the end of the year, at the end of 5 years, at the end of 10 years, at the end of 15 years, they owned no fucking real estate. They transacted real estate. They bought and sold real estate. Same with wholesalers. I'm not saying that's not a way to get in. They made some money, but after a year, 5 years, 10 years, 20 years, they own no assets. They own no real estate. They don't have levers to pull other than to keep working. Where a buy and hold investor may look poor for a bit, maybe a long bit, but they're stacking real estate, they're building wealth, and they own assets at the end of the day. And those are the things, those assets, those real estates, those the property. That's where you're in a position to actually make big moves, to tap the equity, to increase the cash flow, to live and really to live the lifestyle you want. Because flippers, wholesalers, like you have to keep working, you have to keep hustling, you have to keep doing the thing to make money, but you're not actually building wealth and you don't own any assets at the end of the day.
Well, keep in mind the flipper too pays half what they say they make to the government. And people forget that taxes are your number one expense. So that takes a huge hit on your wealth every year when you're paying
Yeah,
half
we don't
of
talk
it.
about that enough. We need to do a whole show on that because we kind of glossed over, I said, hey, tax free. So when you refinance a property, it's debt and you pull cash out, that's debt. So you can access, it doesn't matter if it's 100,000 or 10 million. If you refi, pull that cash out, that is tax-free money. If you sell that property, you're paying capital gains. If you're flipping property, you're paying taxes. If you're making money wholesale and you're paying taxes, but you can access your equity hundreds of thousands, if not millions, if not tens of millions, if not hundreds of millions of dollars that you can access. I mean, people have done it in the billions. They can they can pull that money because it's technically debt. And we should do a whole episode on this and some of the tax benefits of real estate. It's all tax-free wealth. You have access to that equity, that capital, but you're paying no taxes because it's not a true gain. You're just harvesting the equity of a property that you have, and you're doing it through leverage debt.
Well, think about monopoly. Who wins monopoly? The guy that goes or gal that goes around and to buy stacks properties. And when you have properties, now you have levers to pull with houses, which then gives you levers to make hotels. The person that's sitting there with no property and a crap load of cash always loses.
I've won Monopoly buying Baltic Avenue. I think that's the cheap property right there on the corner.
Yeah,
And
Oklahoma City, Baltic Avenue.
yeah, Baltic Avenue. I think that's how my real estate investing started too, man. I Class C and D small multifamily homes, but over time, it's the same exact strategy as I used to play in Monopoly. It's like every time someone passed by, or in real life scenario, every time they're paying rent, it's like they're helping pay the mortgage, they're covering the mortgage, there's cash flow left over. And 10, 20 years from when I bought Baltic Avenue, all of a sudden that thing's worth so much more and renting for so much more. And I'm like, shit, this is Monopoly. This is real life Monopoly.
I love it. Well, I think it's like in the end, a lot of the poor and middle class really, really values money and cash, but cash is a representation of value and it's the byproduct. Cash is just a byproduct. It should not be the focus. The real value, I think, is in the real estate. The real value is getting leverage. Another way to look at long-term real estate is you're buying leverage. Those tenants are waking up, or the business that's inside the commercial building, or whoever the tenant is, they're waking up every single day and working for you. They're working to pay down the debt. They're working to pay, your insurance and your mortgage, your taxes, your insurance, all those things they're working for you. So holding real estate gives you leverage versus the flipper has no leverage. They only have their own labor and the labor of their crew. And so you've got to figure out, what game do you want to play? Do you want to play the labor game or do you want to play the leverage game? Luckily, the leverage game has a lot of other things like tax advantage and wealth over time and cash flow. And so, what game do you want to play? Is it leverage or is it labor?